Hello, everyone. We will give a moment to let everyone in. It looks like we've got some AI note takers coming in as well, which is completely fine. For everyone that's on here, this is being recorded and it will also be shared by the Nevada SBDC. So you can request the recording as well if you want to watch it again. We also post this on our YouTube channel, which is at SBC First. So you'll be able to see it there as well. We still got a couple people coming in, so I'm going to go ahead and keep clicking the button here for a second, and then I will get started. Hello, Paula.
Hi, Christy.
All right, so I think I've got everybody that was trying to get in, um, and I'll go ahead and get started. So we've got pretty much an hour's worth of material here. Oh, still more people coming in, which is totally fine. Um, we are a fairly decent sized group, so I have the chat open. I will try to look back and forth between my slides as well as the chat. So if you guys have a question as I'm going along, feel free to go ahead and put it in the chat and I'll see if I can grab it. To Katie who just messaged me, I'm sorry I can't type at the same time too. That's totally fine. You are more than welcome to be here. The content will still apply. So the question was, I'm not in the state of Nevada. Can I still be here? And so yes, so you'll see on the screen that this is being brought to you today by the Nevada SSBCI. It is a program that is run through the governor's office as well as administered by the SBDC. So, as far as the QR code that's on the screen today, if you are within the state of Nevada, you will likely qualify for the SSBCI program, which basically means it's a lot of free TA that is for accounting, financial, legal. The SBDC will certainly help you navigate through that. SBC Consulting and our team assists with the technical assistance to help with the training. So the SBDC will likely shuffle you to one of our team members so that you can get that extra help that you may need. Part of the SSBCI program also is workshops like this one here. And so we have quite a few workshops throughout the year. You are welcome to join those in the future. Same way that you got the link to this one, obviously, those will be posted in Neosera and you'll know that those are coming up. So we are here today to talk about financial basics for small business owners. As I was telling Katie, this applies no matter what your business is, right? No matter where you are located, however, that program, the QR code there is specifically for Nevada. I will also have this at the end of the presentation. So if you're not so sure, if you need that extra step or that extra help, it will be shared again just in case you missed it just now. So introducing myself, I am Christy Dudgeon. Actually, I forgot to update that. I am now an MBA CBA, which is awesome. Finally went back and got my MBA. But I am the president of SBC Consulting. We are, as I mentioned, a technical assistance provider for the Nevada SSBCI program. Our team is a group of entrepreneurs, small business consultants assisting small businesses throughout the country every day, as well as 2 territories for the United States. Feel free to connect with me on LinkedIn. It's on there at Christy Dudgeon, as well as SBC Consulting. We do trainings for multiple programs, not just the SSBCI program, so we often post those workshops on our LinkedIn page. So you are welcome to join in many of those, depending on what the program is. So, what are we covering today? So, we're going to talk about the keys to success with financial basics. I will be teaching you A simple 4-step process, and I always try to make things as simple as possible. I was a small business owner at one point and had absolutely no idea what I was doing, didn't know how to do bookkeeping, didn't know financials. That was about 25 years ago, so a lot has changed in my life since then. But I do like to simplify bookkeeping into this 4-step process to try to keep it as simple as possible. We're also throughout that going to talk about keeping our business and our personal finances separate. Super, super important, especially if we are seeking funding, tax purposes, liabilities. There's a ton of reasons we have to keep our business separate from our personal, even though we feel like we're so intertwined. We have to untwine ourselves. The three key financial statements that every business needs to have, know, understand, even from the beginning standpoint. That's a profit and loss balance sheet and cash flow. We will talk about those. And then we're going to talk about cash flow basics and 30-day planning, also budgeting for operations and growth. So much stuff we're going to pack into this hour. So if you don't feel completely overwhelmed by the time we're done, I didn't present this correctly to you. So then we're also going to talk about funding readiness basics, what lenders are looking for, and then again, those free one-on-one technical assistance next steps. So throwing a ton of information at you, and then go get that one-on-one help that is available for free, so that you can start to work through some of these things together. So go ahead and drop this in the chat for everyone. Mostly it's for me, just so I understand where everybody's at. Let me know what stage your business is in. So are you pre-venture? You're just kind of here trying to feel it out. You've got an idea, haven't really started yet. Are you in startup? So technically you're putting stuff together, right? And you're starting to build things, or are you in growth? So you finally made it past that startup phase and you're starting to grow your business. So let us know where you're at. So let's talk about those bookkeeping basics and those 4 steps. So the 4 steps are here on the screen. Feel free to take a picture of it or whatever. As I mentioned, the slides, the presentation, everything will be available. But the first and foremost, no matter what type of bookkeeping system you utilize. So when I say that, I mean, it can be a piece of paper. It can be an Excel spreadsheet or a Google Doc. It can be software like QuickBooks or Xero or one of those many other softwares that are out there. However, every single one of them, in order to do your bookkeeping well or accurate, you have to start with what's called a chart of accounts. And I want you to make it simple and keep it simple. And by that, I mean, we always try to overcomplicate our lives. And so we will have this massive chart of accounts that we don't understand any of it. And it's no longer simple. So we want to start simple and then we want to keep it simple. And I'm going to try to figure out how to let these people in here in a minute because I just dropped them. Okay, we got a couple more coming in. All right, second thing we need to do is to categorize all of our transactions accurately. Now, this is the one that's actually the most scary to most people. This basically means we're taking each transaction and we're putting it in the right bucket. That's all that means, although that can be scary because we're not really sure what those buckets are. Well, guess what? Those buckets are the chart of accounts. And I like to look at it that simple way as we just kind of drop them in those buckets. That's why we need to keep that chart of accounts as simple as possible, because when we go through categorizing, if we have too many buckets, it can get overwhelming and difficult. Then we need to reconcile monthly. We're going to talk more about what that actually is. And then we need to review our reports. So I already told you what those 3 reports are that are extremely important, but we're going to cover those today as well. All right, next slide. So step 1, chart of accounts, as I mentioned. There are 5 things that you have to know. Don't overcomplicate it. Keep it simple. You will probably hear me say that 5 times. Chart of accounts. These are the 5 that you have to know. They're on the screen here. So bookkeeping is a very broad term. Understand that part of it, not just meaning a bank account. So that's also why I call those buckets, because sometimes chart of accounts gets a little confusing too. So every single account in your chart of accounts will fall into one of these 5 main headings or main categories or account types. They could be called multiple things. As long as you know what these 5 are, then this will help you to categorize so that you can understand that you've got them in the right place. So it is assets, liabilities, equity, income and expenses. And since we're a short class today, I'm not going to make you repeat those, but normally I would. So there can be multiple accounts within each of these account types then. So we could take these 5, then we could add more into them. And this is where I talk about things can get overcomplicated, right? Because we could layer on top and layer and layer. And really, we just started with these 5. An asset, these are things that the business owns. Remember, it's a business, right? Not the personal. Things that the business owns and they have a value. So these are things like bank accounts, accounts receivable, equipment, property. We can usually touch, see, feel these things, right? And we can turn them into cash very quickly. So that's really what from a lending standpoint, they care about that. So we own them and they have a value. Liabilities, these are things that we owe and they also have a value. So these are things like loans, credit cards, accounts payable. Equity, this is the one that's the most confusing to everybody. I will try to explain it in a very simple way today, but this is really the value of the business to the owner. Now, this doesn't mean this is what your business is worth if you were going to sell it today or anything like this, but this is the value to you. So this is how most small business owners will pay themselves. This is also how and where you would accurately track business and personal transfers that are happening. So if we do spend money and oops, it's business money, we spend it on personal, I'm going to tell you how to use it through equity. Vice versa also. So we're building our business. We don't really have money coming in yet. We're buying everything from our personal accounts. How do we actually track that as a business expense? We are going to use equity, and I'll show you a couple of keys to that. And then we have income. So this is money that comes in. That's the business that we receive, right? For what we do, for what we're selling. We're providing labor, we're producing a good or service, it's through investment capital. These are all different kinds of income. And then we have our expenses. And I know that I said there were only 5, but I like to talk about expenses in 2 different fields because they're very important. So there are 2 types of expenses to keep in mind. And these are direct and indirect. That's how I refer to them anyways. They're also known from a direct side, cost of goods sold. You will see these if you're using something like QuickBooks. On your taxes, they'll call them COGS or cost of goods sold as well. So this is money that we spend or expenses that we have that are directly resulting because of something we sell. That's a long way of explaining it, but if you kind of track back through it, it does kind of make sense, right? So if we have to buy something to sell it, so we're buying a product, we're reselling it, that is direct. That's a cost of goods sold. If we're buying pieces and parts of things and we're putting them together and then we're selling that final product, all of those pieces and parts and things that we're putting together are considered direct. If we're a landscape company, service-based company, something like that, and we've got some materials and we've got labor and people are paying us for that end result that we're producing out of the materials and labor, that's direct as well. And so you kind of have to scrutinize your expenses to say, did this result in revenue, right? Did this result in income because of this expense? Or is it something else? And so basically it's either direct or it's everything else at that point from an expense standpoint. So indirect is also called overhead or also administrative or operating expenses. You'll see these phrases on all of them. And this is just the cost of doing business. So this is basically all those expenses that we have just because we are a business, right? So this is our rent. This could be our office supplies. This is, if I buy t-shirts for someone, our advertising, all of those things, we're going to have those expenses whether we sold something or not. It's just the pleasure of doing business. So as I mentioned before, do not mix your personal and business spending. Happens a lot at the very beginning, but you want to get to the point where you can get these separated as quickly as possible. There is a term for that. It's called commingling funds. Your business book should only track business activity. And one of my beefs with something like QuickBooks, I will stand on my soapbox and yell about it, is that they always will set up your simple chart of accounts in their world to have personal items tied directly into it. And it's usually in equity. And that drives me nuts because it was drilled into my head by the very first CPA that I worked with in business that I absolutely should never have any kind of personal item on my business books. And she was not wrong. We do not want to open ourselves up to any kind of conversation about the personal expenses that we have that our business might be paying for, right? And that's why we use what is called equity. So the best practice setup to make sure that we keep these two things separate is that we open a business bank account. Now, to get a true business bank account, right, you already have to have your business set up as far as, are you an LLC, sole proprietor partnership, or are you a corporation? We have to have our EIN number also, right? So we have to go to the IRS and get our EIN number. The bank is going to ask for that to give us a true business bank account. If you're not ready to that point, though, you can always have a personal account. Most banks will give them to you for free. And you can keep money separate that way, right? So it doesn't have to technically be a business bank account. I say this with credit cards also. So definitely in the beginning, if you're using credit cards, or you're using credit cards to kind of patch things through on your business, just don't use your personal credit card in the sense of you're already using it for a lot of other personal purchases, right? So if you have more than one personal credit card, just take one of those and use it for business, and don't use it for personal. So that way you can track it better and you can keep those items separate as much as possible. So if mixing happens, I am saying it is common. I do this periodically because I have two American Express cards, one for personal, one for business, and I will accidentally grab the wrong one. They're both blue, right? And so it happens. I've also gotten calls from business owners, panicked before, saying, "Oh my gosh, I didn't even have my personal card and I didn't even realize." It's okay. There is a way to track that appropriately. And really, that's what matters, is that we track it appropriately. And so we're going to use our equity accounts to track that money that's coming in and going out. So there is something called an owner's contribution. Maybe it's called an investment. These are somewhat QuickBooks terms just because a lot of people use those. You just want to have a chart of accounts or an account in your chart of accounts where you can say, this was money I put into the business, is basically what you're saying as the business owner. So if I had a business expense that I paid from my personal funds, what I'm going to do is call that an investment into the business, and then I can call that an expense. So we don't want to call that income. Anytime we put money into the business personally, as the business owner, that's not income for the business. We'd be paying taxes on that. We don't want to do that. We're going to call that an owner's investment. So if we're transferring money from our personal account into our business, that's where we would call that. We would call it investment. Or, as I mentioned before, if we have a business expense that we paid for on our personal account, then we would do it that way as well. So then what do we do if we use business money or one of our business accounts to pay for something personal? So this is pretty common. Like, we might pay for our health insurance. We might have paid our car payment at some point. We shouldn't do that, but we might pay our state taxes, income taxes, things like that occur very often from a business owner standpoint. However, the business doesn't care regardless of what we did with the money at the end of the day. The business does not care what we did with it, right? So we only have to call it an owner's draw. It can be called owner's pay and personal as well. So that's the opposite of owner's investment, but it's both going to be sitting there in equity. So some people use the same account, that's money coming in, money going out. So, and a lot of people will separate those two so they can keep a better tracking of what was an investment and what was a draw. So this is a personal expense that we paid from the business fund. So as I mentioned before, the business doesn't care. It looks like somebody's off mute. Let me see if I can mute everyone. Um, so the business doesn't care what you do with the money. So therefore, you do not have to have those differentiated accounts in there that say it was a personal expense for healthcare, or it was a personal expense for taxes, or whatever that may be, right? It could have been your vacation. It's really not important at that point. It's just that you've tracked it appropriately to say that it was going into your pocket. So important reminders: keep owner pay separate from business expenses. Do not categorize personal spending as a business expense. This is where you get in a lot of trouble, especially if you were audited, right? Because you're going to get scrutinized, and the IRS is going to say, oh, no, that was a personal expense, therefore you get to pay taxes on it. And I like to say the word flag it, clean it up so that your reports stay accurate. This is basically if you're using any kind of system You might want to highlight it even if it's on the bank statement, right? And you're going to make sure that instead of saying it was an office expense or a business meal or whatever it might have been, if it was for personal, you're going to call it that owner's draw or that owner's pay and personal and put it correctly into equity. So it matters because clean categories equal accurate reports, which equal better funding readiness. So we need to have proper financial reports generally for three reasons. One, we're trying to get financing, so the banks are looking at them. And if they are not accurate and clean, that's really going to slow down our loan process. The second one is we need them for tax purposes, and there's really important reasons for them to be accurate there as well. We don't want to pay more or less taxes than we're required. But the third one, which actually I think is the most important, which is, sadly falls to third, is this is how we run our business and this is how we understand and grow the business. So definitely having accurate reports to be able to make those business decisions is extremely important. So on the screen right now is a very, very simple chart of accounts. So we're starting with a checking account, that's an asset. We might have a credit card, that's a liability. Then we've got that owner's draw and investment in equity. We've got one income account. This is for our income and sales. We've got one cost of goods sold in there. That's our expenses. And then we've got all the rest of our expenses, our indirect expenses there. You notice this is pretty small, right? And this is a great place to start. A lot of businesses, you might have something that you can't quite fit into one of these buckets and you say, okay, I need another account for this or I need another account for that, right? Maybe you pay payroll, things like that. You're definitely going to have more accounts than this. But generally, if you're a business that's just starting out, this is a pretty good small little chart of accounts to start with. And it's simple to start maintaining your books or your finances. So step number 2 is to categorize our transactions. So I mentioned this before what this is, but our best practices are be consistent. So no matter what, and it's funny, I've had people sit in my little workshops and they've come back to me before. They're like, I heard you say this, but be consistent even if you're wrong. So what I mean by that is we are uncomfortable at first. So we're not 100% sure if it's supposed to go in the advertising bucket or it's supposed to go in the office supply bucket or where we're supposed to put it. Well, be consistent with where you're putting it because if at some point someone is helping you clean up your finances or move things around, right? Or you're sitting one-on-one with a consultant, whatever it may be, it's a lot easier to unwind things when you did them consistently wrong, as opposed to just choosing something different every single time you do it. So that will help save you money, especially if you're paying someone to help you unwind that stuff. So be consistent with it. And the more you do it, right, you're probably going to figure out, oh, wait, I probably should have been using this other bucket for this now that I've learned something else, right? And so you can certainly update and change the way that you were doing things. But I have seen many things where it's like, oh, well, I thought maybe it was that, but then I wasn't sure. And then I put it over here and then I put it over there. And that is a lot of work to unwind that kind of stuff. So categorize what it was for, not by the vendor. So I've seen this a few times too, especially with things like Amazon, because that can be so many different things. Someone will create an account in their chart of accounts called Amazon and just start dropping things in there. That's completely inaccurate. You don't want to do that. So make sure that you're separating it out. Like Amazon can be cost of goods sold, it could be office supplies, it could be personal things, right? We might have one order from Amazon and we never know how the orders are going to come. And so things can be all mixed up. So definitely make sure that you get those separated out and everything that was in that order is in the correct categories. Keeping your business accounts for business spending only, talked about that. Keep your owner pay separate from business expenses. So when you pay yourself, right, you're calling that owner's pay and personal unless you happen to be a W-2 employee. There's not a separate expense line that you're going to have in there and call yourself an owner's expense. There's a few reasons for that. And I mentioned that before, the sole proprietor partnership LLC, we can pay ourselves through owner's pay and personal. And that means that we do not directly affect the profitability of our company as the business owner. So obviously, if we're paying employees, that's a little bit different. They're not going to be equity, they're going to be considered expenses. But we ourselves are considered equity. You're recording transfers as transfers. This is can get convoluted sometimes, especially if you have a lot of bank accounts. You definitely don't want to say that you transferred money from a business account to a savings account and accidentally call that income, right? Because we don't want to pay taxes on money that we're already paying taxes on. So you want to make sure those are accurately recorded as transfers. And technically, those are just moving from one asset to the other because those are our bank accounts, right? And the same is for if we're paying a credit card. So we want to make sure that that payment is coming from our asset, our checking account, and then going to the liability. So we've got that correct transfer. A credit card payment is not an expense. It's what we spent that money on in the first place. So every time we swipe the card, right, is the actual expense, and that's when we need to put it in the appropriate bucket. But the actual payment to the credit card, that's just a transfer from an asset account to a liability account. Payment processors, beware of these. If you use like Square or Slice, or there's so many of them, Clover, if you have e-commerce, so you have Shopify, is somewhere where you're accepting money, right, that's being processed by a payment processor. These deposits are not just sales. So very common. And maybe throughout the month, it's really easy to call a deposit from a payment processor, just call it sales. However, there is a wonderful report that almost all of these payment processors, every single one, in fact, will be able to provide you with at your fingertips that actually is going to tell you what was within that deposit. And what you will find is that that deposit also is missing money, right? Because the payment processor is already holding back something. So, in order to make your books accurate or to make your financial statements accurate, you will need to differentiate what was actually in that deposit. So, there's often sales tax that's in there, refunds might have happened, right? So, that's affecting our income. When the payment processor holds back their fees, that drops the amount of income that's coming in if we're using one of those automated systems. So be very careful about payment processors to make sure that you can separate those things out appropriately. And then you might have to do a journal entry or something like that at the end of the month in order to get things to be aligned directly with those reports. Just be aware if you use multiple payment processors, that can be even more fun. So try to stick to one if at all possible. Your future self will thank you for that one because it can be a lot of work to untwine. Add notes for any unusual transactions. This is another one where your future self will thank you. Most softwares have the ability for you to put a memo in there. You will be asked in the future. If you had to ask yourself, what was that really? And then you go back and you look for it, add a note, because in the future, an accountant, a tax accountant, someone like that, a lender, who knows, may ask, your consultant may ask you that question and say, what was that for? And you don't want to have to go back and look it up again or try to figure it out. So notes are super helpful for these types of things. And then review any uncategorized items monthly and resolve. I've seen this before. QuickBooks, for one, and any other accounting software will let you have these gigantic accounts that are called uncategorized or miscellaneous or general. Don't use those. Those are actually red flags when it comes to the IRS. So you want to make sure that you are breaking apart whatever those expenses are and not just dumping them in. I've actually seen, and God love Facebook, Instagram, all those wonderful things that are happening out there. But there is some really bad advice out there, and I've actually seen someone who recommends that you just dump everything into uncategorized, then you reconcile, then you go back and unwind it. That's like twice as much work or three times as much work than you want to actually do. So you definitely want to be categorizing on the front end and making sure that you're categorizing everything instead of just dumping them into one of those buckets just for the sake of clearing some things out of your accounts. So common mistakes that we'll see: loan payments. This is the same kind of thing I've seen with credit card payments. I've seen it with mortgages. They're not expenses, right? So we are physically paying a loan. Now, if you're making loan payments and you can't figure out where to put them, it means you might not have actually put the liability into your chart of accounts as well. So the liability is that amount of the loan. And then when you make the payment to the loan, you need to make sure that it's principal and interest, unless you have an interest-free loan, which is so rare these days, but good job if you do. That just means 100% of the payment is going to the principal, but most of us are paying some kind of interest on those. So the principal will come down by just the principal amount, but the interest itself is actually an expense. So we want to make sure that we are appropriately accounting for the amount of interest that we're paying. Credit card payments are usually a payment or transfer. They are not an expense. It's the actual swipe of the card that's the expense. Transfers between bank accounts, I mentioned that before. Owner's draws or personal spending from business accounts, make sure we are putting those into owner's draw and those appropriate equity accounts, not calling them an expense. Deposits that are not sales, so loans, right? So maybe we got a loan and that actual depositing of that money for the loan, that's not income, that's not sales. We don't want to call it that because that's going to show up on our financial reports and we're going to pay tax on it. We actually want to call that our liability. That's the amount of the loan, and then we start making payments against it, and that loan payment will start to come down. Owner's contributions, I mentioned that one before. So any investment that we make, or any transfer from a personal to a business, don't call those sales. And then refunds also. So that's actually going to drop the amount of income that we had if we appropriately count for that. Refunds, and another side of that is if we return something, right? So the return is actually going to drop the expense for whatever it was to begin with. So I use Amazon again as an example of that, right? We ordered something from Amazon, we called it office supplies maybe, and then we returned it. So then we just need to reduce the office supplies. We're not going to put that money back in as income because, we got that money back. Sales tax collected, payment processors deposited. So we talked about the payment processors. Sales tax is not income either. This is a big cash flow problem that a lot of small businesses get themselves into, because we'll have that sales tax that we've collected deposited into an account, and we think that we have more money than we do. Until we have to turn around every month and pay that sales tax back. I have heard many nightmares of small businesses getting into trouble with sales tax. I do recommend, if you have to do it, it might even be better to have a separate account just to have the sales tax deposited into, because out of sight, out of mind, right? Like if and I'm not going to accidentally touch that. If I'm not comfortable with using my reports yet and really understanding what cash flow actually means. Equipment sometimes recorded as supplies. What I mean by this is if it's over a certain value, so if I bought a truck or a tractor or something big, right? These are actually called fixed assets. They're not actually called supplies or expenses. An accountant will help you determine what that value is and to make sure that you're accurately recording those. Business versus personal meals. The IRS actually has two different classifications for meals. One's 100% deductible, one's 50% deductible. But if you're eating alone, you just happen to be working, they don't like you when you do that. So most accountants will recommend that you just completely keep those out of your business expenses. So there's certain specific criteria that you have to fall into. And then vehicle costs. So do you own the vehicle? Does the business own the vehicle, right? So this is very common in startups as well, as you're using your personal vehicle for business use. How do you actually account for mileage or the fuel or the repairs? And really that comes down to what you're using it the most for, right? Is it business or is it personal? And there's certain tax advantages going one way or the other. Definitely have that conversation with your tax accountant before you decide which way to go. So sometimes it's better for you on the personal side if you're just accounting for mileage, so you're keeping a log, as opposed to paying for your actual car payment or your fuel or your repairs. So that's more on the tax side for why you might do that one way or the other. So talk to your accountant. One-off or special transactions, I mentioned those fixed assets that you would add those to your chart of accounts. They do have a separate line. You are going to track what the value of those are because they have something called depreciation that is an actual expense that you can take year after year over time. Again, an accountant can help you out with that. New loans, lines of credit, we have to have those listed into our chart of accounts as well, so that we know that we have a loan, right? So we have that liability as well as being able to track them correctly. Refunds, chargeback, reimbursements. I talked a little bit about this. Grants and program fundings. So there's specific places and ways that those need to be accounted for as well. And then major repairs and or replacements. So these are like capital type improvements, right? These may not be actually an expense in the year. These may be considered assets as well. So there are a few things that you will probably run into where you go, oh my gosh, I have absolutely no idea what to do with this. And that's why you work with either an accountant or a bookkeeper or someone like that that can help you sort those things out. All right, so from the chat, you guys can add these in again. Which one of these, of all these wonderful things that I just told you about, do you think you're the most unsure about? So how to categorize a loan payment, a credit card payment, owner's pay, payment processor deposits, or all of the above? So which do you think causes you at least the most problem now, or that you still have the most questions about? You can drop that in the chat. And then I'm going to move on. So step 3 in bookkeeping is reconciling our accounts. So we've talked about step 1, which is have an awesome chart of accounts, and we're going to keep it simple. Step 2 is we're going to categorize everything, which means we're going to take all of the transactions that happen in our business and we're going to put them into a bucket. And then step 3 is reconciling our accounts. What reconciling means is this is the process of us confirming the value of our accounts are correct. And the most accurate way to do this is monthly. We typically receive a bank statement every single month. So we'll receive credit card statements every month and loan statements every month as well. Even if we are categorizing things weekly, right? So we're taking things and we're putting them in those specific buckets, we can still make mistakes. It happens very commonly, actually. Even the best will make those mistakes. Or remember how I said maybe we were categorizing things into one particular account and then we learned something, and then we realized we were doing it wrong. We can also fix that most easily at this point. So during reconciliation, a few of the things we're doing is we're finding missing transactions. So even automated systems that are supposed to be feeding in all of our transactions do have glitches. They're actually pretty common. And so transactions might be missing. We might also have duplicates. So maybe we did a transfer wrong. And so we've got that showing up twice in our account. Maybe we recorded something and then we had a bank feed situation like we would have with QuickBooks and we recorded it again. So we've got duplicates, transfer errors. I mentioned bank errors. You'd be shocked. Banks make errors all the time. They generally fix them, but they don't always. So it's also a good point to be like, wait a minute, I don't know what this is. And then also those miscategorized expenses. So if there's something that happens to be uncategorized or general or miscellaneous or whatever, reconciliation is a process where we're going to fix that as well. So we're going to go through all of our statements after we've categorized everything. So we've got to categorize everything first. We're going to review our reports and we're going to make sure it looks right. So once,
Christy,
yeah.
I'm not seeing the chat. It says chat disabled on my end. I don't know if everybody else is
Oh,
having the same issue.
I don't know. I have actually people that have chatted with me. So,
Okay.
Mine disabled also.
huh. James just told me hello. So
Okay.
I don't know.
Okay.
So yeah, I don't know if that's a setting that is causing that problem. I will hopefully I'll talk real fast and get through most of this, and then we'll have time for you guys to be able to ask questions off mute when we get
Okay.
to the end. So if you're not able to drop that in the chat, but yeah, I have a couple people that are private messaging me separately too in there, so there might be some kind of setting that's preventing that. So we reconcile, which basically means we've categorized everything, then we're matching everything up against our bank statement. And so we're confirming that all those transactions that we've dealt with during the month are correct, and that our values are matching. And so then we're going to look at our reports once we've reconciled. So we're going to look at that profit and loss and that balance sheet. We're going to go into those a little bit more. And we're making sure just from a structural standpoint, visual standpoint, that everything looks right. Now, this is, again, pretty hard thing at the very beginning, right? But the more that you look at your reports, the more you're going to start to understand them. And the more that you're going to start to say, okay, something was off here, or no, I didn't spend that much money, or really, did we make that much money? I get that question a lot. Or how in the world do we have this much profit? I have no money in the bank. Those are all pretty common things. So we want to make sure that the income looks reasonable for the period, that the major expenses make sense. So nothing unusually high, nothing missing, no large amounts sitting in those uncategorized or miscellaneous. Owner pay and transfers are not showing as expenses, right? Loan payments aren't overstated in the expenses. Our payment processor income and fees look accurate. So obviously if we have a payment processor and they have a fee and there's nothing in there for the month for the fee, we're missing something. So we need to go figure that one out. And our cash balances are what we would expect, right? So this is just gut feeling really at this point. We're looking at the data and we're trying to make sure everything looks right. And then we can dig into those reports a little bit more. So depending on whatever system that you're utilizing, you can actually click into some of those reports, see every single thing that's in one of those buckets, right, within those reports, and then you can make further corrections from there. So when somebody says to me, oh, that's not right, I didn't spend that much money there, we would click into it, they would look and they would be like, oh, I guess we did, like all of those are correct. Or they would see that they miscategorized something. You could easily change the category and you can get it to the correct spot in the report then. So this helps you catch those errors early, as opposed to letting everything build up all the way through the year and then you're scrambling at tax time to do 12 months of stuff. Generally, it's a lot fresher in your mind when it's just the month prior, right? Also a lot less data to handle when you're looking at it monthly. It keeps your books accurate. It helps you trust your numbers. This is a big one. So I've talked to so many people that they say, I don't trust my report. Like the numbers are wrong in there, right? And there's the only reason their numbers are wrong in there. It's your chart of accounts you didn't understand in the first place. You didn't categorize things correctly. You weren't reconciling, right? And so I wouldn't trust it either, right? If I wasn't doing that. But if we're doing those three things, we can make a lot more confident decisions and trust our numbers. It also makes funding readiness much easier because, again, in our loan packages, if we're seeking funding, they're going to ask for these reports and they need to be right. Sadly, a lot of people find out at that moment their reports are incorrect. And that's not the moment that we want to find that. So simple habit, you'll notice in my kind of loop down here at the bottom, I dropped out the chart of accounts because we generally only have to do that once. And then we have to add accounts as we get new loans or we buy new equipment or something like that. But once you've got it set, it's there. So our simple habit, categorize, reconcile, review, then we repeat every single month. And this can be a once a month thing that we're doing depending on our business, but categorizing generally it's a little easier if you stick to stay up on that throughout the month. And not save it for the end of the month, because I can tell you, I barely know what I did yesterday, let alone what I did 3 weeks ago, especially in the world of business, right? So the more that you stay up on it, the easier it is for you to be like, yep, I know what that is. I know what that is. I know what that is. So those 3 financial reports that I mentioned, what are they? Why do they matter? Balance sheet, income statement, cash flow statement. So here's just a little napkin doodle about it. Financial statements, they help us track our growth. They let us know if we have enough cash. How do we manage our resources? The lender is going to know, is this a good investment? Are they a risk? What red flags do they have, right? They're going to know this all just by looking at 2 reports. We can talk as much as we want to try to explain ourselves. They want to see these 2 reports as far as the balance sheet and profit and loss. So what does our balance sheet show us? So we talked about the 5 accounts, the big 5, as I always refer to them. Those first 3 accounts, assets, liabilities, equity, are all on the balance sheet. The other 2, income, expenses, happen to be on the profit and loss. So there are 2 reports that show us every single transaction that our business ever has, right? Because we're only able to put them in those 5 main category types. This is why I say keep it simple, because you can have 500 accounts, but they all flow into those 5 and they all end up on these 2 reports. So business owns assets, liabilities, equity. We talked about that, right? This shows our overall financial health. It helps the lenders understand our risk. It tracks our loans, equipment, and owner activity. We want to review our cash balances. So are these correct? Our loan and credit card balances, are these accurate? How do we know those are accurate? We reconciled, right? So we match them against a statement every single month. Therefore, we know those values are correct. Owner contributions and draws, do those look reasonable? Were we putting money in the business? Were we taking money out of the business? We'll see that in equity, right? Under those. This answers where does my business stand right now? Profit and loss. This is the one that most business owners will start with. I highly recommend that, right? The balance sheet doesn't change quite as often. It's just a lot of values. This, however, if you're making money, spending money, it is happening on this report every single day. This is our income and expenses. So how much money did our business make? We're going to know that from here. How much did we spend? Whether we made a profit or a loss. So if you'll notice in my doodle, you probably have heard the phrase the bottom line. The reason it's called the bottom line is the very bottom of this report, which is where most business owners go first. You're going to see a positive number or a negative number, and that tells you if you've got a profit or a loss. And that is the whole point of this report. There is tons of other things, though, that you will learn from this report. This is how you know your gross margin, your profit margin. This is how you know if you need to control your material cost. This knows, from an income standpoint. Tons of stuff you can learn from this report, and the more that you look at it, the more that you start to understand it, the more the questions you're going to ask, and you're going to start to scrutinize things. So you want to know, does the income look accurate? Did the major expenses make sense? Are there any unusual transactions or missing items here? All in all, though, am I making money? Now, remember I mentioned before, a lot of people will ask, I'm profitable. Why in the world do I have no money? That's the question here. Sorry for those that you can't say in the chat. But have you ever been profitable on paper, but you were short on cash? Almost every single small business at some point is going to say yes to this. Unfortunately, a lot of you are probably still saying yes to this, but there is a way to help you have visibility to that and to understand that. And that is called the cash flow statement. Now, the cash flow statement, there has to be a little bit higher level understanding to what you're doing in order to step into the cash flow statement. But from a simple standpoint, you have to be able to know when is my money going to come in, or where is my money coming from? So when I say that, if you're a retail business and use a point of sale business or a point of sale type thing, right? So someone walks in, they buy something, they pay you. It's happening at that very moment. You're pretty much saying, I think I'm going to make X number of dollars this month, right? And that's sales projections and things like that. And that can be kind of hard to pinpoint early in business, but you have to guess, right? So we're hoping we're going to make this much money. However, if you're a business that invoices people and you've given them 15 days or 30 days to pay you, you can then do kind of this projection from I'm going to receive this money, or you have this expectation that somebody's going to pay their invoice this week, next week, the week after, right? Based on when you've invoiced and that money is then coming in. So you've already done the work, you've invoiced them, and now you're just waiting to get paid. And so that's where that operating activities, that's over on the right-hand side, is coming in from. Also, there's some negatives from operating activities as well. So when is the money going out? So we also need to know from investing, so when our loan payments needing to be made, this is helping us make decisions basically on when we can and cannot pay our bills, for one thing, as well as when we should or should not spend extra money. So we're basically looking forward now. We can look forward 30 days is pretty much how people do with cash flow, where our profit and loss and our balance sheet, we already did all that, right? So that's behind us. So we're looking backwards with that. So cash flow, we're looking forward. When do we expect to receive money? How much money do we expect to receive? When do we have to pay certain bills? When do we have to pay loans, right? And so we can plot all that out so that we can say, all right, I'm not going to be able to pay my bank loan this month because I'm not going to be receiving any money in. Really what cash flow planning or cash flow statements, and if you've got an automated system or you're using something like QuickBooks to its fullest, and what I mean by that is if you're actually putting bills in there and you're putting that clock on them so that you know when those bills are due, this will help you have an accurate cash flow statement. So this helps you understand why cash may feel tight at certain times, right? If you've got payroll that you've got to make and suddenly you look at your bank account and there's nothing in there, this is where that sales tax part that I was mentioning can kind of get you into trouble, because you look at your bank account, you think you have money, you really don't. Guess what? Sales tax payments should be on your cash flow statement or your cash flow report. It helps you plan ahead. It helps you support smarter spending decisions. And also let you know, are my customers paying on me on time? Do I need to go back and I need to make sure that somebody is paying? Are there invoices that got missed? Are my bills and debts draining all of my cash? Is my cash flow over time improving or declining? It also will let us know if we need to get into an emergency situation before the emergency actually happens, right? So the kind of that thing where I was saying, nobody's going to pay me this month. My invoices aren't going to come in, but I've got this to pay, this to pay, this to pay, right? That money's got to come from somewhere. And if I'm going to drain my bank account, then that maybe I have to infuse personal money. Maybe I need an emergency loan, things like that. And so that's why a lot of businesses also have lines of credit, right? Because they're helping them at times like this. But having a true visibility to that cash in the future is going to help us better plan for that. So cash flow is all about timing. It's not about profit. We could be extremely profitable and have no money in the bank or negative money in the bank. We could be extremely profitable and go bankrupt. That happens too. So why cash flow feels tight, income comes in after the work is done. So that's kind of that invoicing, waiting for the money to come in. Bills, payrolls, taxes come out before we're paid. One late payment can throw everything off, especially if we're running really tight. So a simple 30-day cash flow check, looking ahead, not backwards. Money coming in, those are as expected deposits, invoices, sales. Money going out, what's our bills, payroll, subscriptions, debt looking like in our next 30 days. Set aside for taxes. That's a big one. Sales tax, income tax, depending on the time of year, right? And then what's left is what guides your decisions. Can I buy extra inventory? Can I buy extra materials? Can I give my team a bonus? Those kinds of things. And cash flow is going to be able to tell you those. This reduces those surprises. It helps us plan our expenses early, shows us our problems early, gives us a lot more control over our business. So if we can see 30 days ahead, man, we can make so much better decisions instead of just going, I think we can do it because we've got money in the bank. Budgeting, I'm going to skip through budgeting really quick because we need to get to a couple other things here. But budgeting is different than cash flow, right? So cash flow is actually showing us what we know a little bit
We got
supposed to happen. Budgeting is that plan for that entire year to say, this is what we think the year is going to look like, and this is how we're going to plan to spend our money or our income, right? So these are those projections on month by month. And then we want to compare this budget then to something like our profit and loss, right? So did we make the money that we intended? Did we spend the money that we intended? In highly volatile times, right? So like I want to just say the last 6 years have been pretty volatile ever since COVID. Inflation, prices are going all over the place, right? So really sticking to that budget or trying to stick to that budget, we can see when things are creeping kind of out of those parameters that we set up. But a simple budget really helps us keep our business on track. So we can have budgets that are a monthly plan. We can base these on estimates, show where the money goes, helps us with planning, focuses on categories, as opposed to that 30-day cash forecast that we were talking about. This is just a short-term cash view. It's based on real timing. It shows where the money is moving. It helps us avoid surprises, and it focuses on dates. So these are two differences in a budget versus a 30-day cash flow. So are you running your business, or is your business running you, right? That's the thing.
my business running me right now.
Yeah. Well, that's why you're here, right? So funding readiness basics. So I've talked about that. They're going to ask for your profit and loss statement, your balance sheet. This is just a checklist of what's commonly asked for. So not just SSBCI funding, but SBA funding, maybe conventional funding rate. These are the common things that someone is looking for. That profit and loss statement, balance sheet, cash flow information, or projections. So if you are a pre-venture or startup, you're probably like, Christy, I have no transactions that are happening, how in the world am I going to have a profit and loss and balance sheet? We do something called business plans, and we create projections, right? So businesses can get a loan when they haven't even made the first dollar yet. And that's, startup expenses or whatever that may be. And you've got to have a great business plan in order to do that. If you are up and running, they're going to ask for your business tax returns. Your personal tax returns are often required, so be prepared for that. If you have personal credit issues, we do often have the credit workshop that's through this as well. So jump in on that one if you haven't already, because you are going to be asked for those personal tax returns. Bank statements, debt schedules. So who do you owe and when? So this is your liabilities that you already have. That business plan, as I mentioned before, or the use of funds explanation. So what are you going to do with the money once you have it? And then credit information, both business and personal. What they're looking for. Can this business repay the money? Is the business financially organized? So that one right there is why you want to make sure that your profit and loss and balance sheet are in order before you go to them, because they're definitely going to be checking if you're organized. Does the owner understand their numbers? So do you understand your business? Do you understand your numbers? Do you know where the money's coming from, where the money's going? Confidence and clarity matters just as much as the numbers. So they're going to look at those numbers, but then they're going to ask you a lot of questions. So how can SSBCI help you then? This is personalized one-on-one support at no cost to you. It's a federally funded program through the Department of Treasury. It is awesome. Anything from financial, accounting, and legal falls under SSBCI. If you need help with marketing, I'm sorry, we can't help you, but the SBDC can. So there are free resources out there for that type of thing. But here's a few things. SSBCI can help you organize and clean up your business finances. Big one, right? Because they want to make sure that you are prepared to seek capital whenever you're ready. You do not have to be looking for a loan to participate in the SSBCI program from a TA standpoint. However, the whole point of it is to improve your access to capital, right? And to get you more prepared. They can help you set up and improve your bookkeeping systems, understand your financial reports, build a budget and cash flow plan, prepare for that financing and funding applications, review loan requirements and documentation, get clear on credit readiness, so business or personal, as well as create an action plan. So you have access to one-on-one assistance through the SSBCI program if you are in the state of Nevada. All you have to do is scan that QR code or put that link in there, and there's a short little registration that you have to do. The SBDC is going to get that information, and then, like I said, they will send it over to us. And one of our team here at SBC will most likely be assisting you one-on-one with whatever that is. So jump into a future workshop if you don't need one-on-one. This program is going for the next 3 years. So it's typically until funds are exhausted, so I wouldn't say wait, but if you need help next year or whatever it is, we'll probably still be here putting on these workshops and webinars, so we'll be helping you there as well. So we do have a few more minutes for those of you that weren't able to ask a question, if you want to unmute, we can have a quick chat here and I can try to answer any questions that anybody has. It looks like everybody was not able to group chat. However, they were able to send me the information. So that appears to be a setting. Sorry about that. Yes, Elizabeth asked, can we get a copy of the slideshow? So these slides are going directly to the SBDC. I would ask them directly for a copy of that. As I mentioned before, they're going to have a copy of the recording as well, that they're going to have in their recordings, but it's also going to be at SBC First, the YouTube page as well, once I put it up there. So give me a couple days. I have a question about, I'm a new business, hitting the first anniversary, struggling to get sustainable and profitable, need lots of options. It sounds like you should probably hit that QR code, and ask for assistance, with, recommendations, getting organized, that kind of thing. Presentation will not be emailed. That was another one that was a question in there. This is going to go directly to the SBDC. They actually are the ones that have all of your emails. Unfortunately, we do not. So actual separate banking accounts, or are they just recorded on separate spreadsheets? So that's an interesting question. So, when I was talking about business accounts versus personal accounts, and obviously the word spreadsheets got thrown in there too. So it's just depending on however you are maintaining things. If you have more than one bank account, you are going to create an account for it in your chart of accounts. So you're going to create a separate bucket. So if you have multiple business bank accounts, each one will need its own line in your chart of accounts because you are going to be recording transactions with that. If you have a savings account, it's going to have its own account or its own bucket, as well as any credit card accounts. So that's how you would keep all of those separate. You wouldn't necessarily have them on different spreadsheets if you're using a spreadsheet. You would keep the numbers at least in that separate chart of accounts. And there are some pretty decent, actually, spreadsheet type situations that help you keep those things in line. That's not just you going into Excel and filling in a few cells, right? They're kind of pre-created and have some calculators and things like that. Let's see. I have a question about if you created this company or you just could be an independent contractor. Joy, can you, if you're still on here, can you send me another message and let me know exactly what that question was? Because I'm not sure what I was talking about when you asked that question. Let's see. I think I'm almost through everybody. Yeah, so I don't know what happened with the group chat. Sorry about that. Yeah, Nicole, so add SBC first on YouTube. Otherwise, ask the SBDC for a copy of this as well. So I had a question about, should I consider my bank account money as cash? And this can be one of those confusing questions with what is really cash and like a cash account and what is a bank account, right? And so if you are dealing with cash, so maybe it's a farmer's market situation or people pay you in cash, and you never actually ever deposit that money into a bank account, and maybe you use that cash and you paid some expenses or things. I would recommend that you have a separate line in your chart of accounts that is for cash, and you would keep track of that just like you would if it was its own bank account. So petty cash is a name for it, right? Or some people have a box that they put the money in. So you're going to record when money comes into that. When you receive the cash, so was it sales? And then when you pay it out, was it an expense, right? And you want to accurately record those. So a bank account itself, and it's kind of a terminology thing, we don't necessarily consider that cash because it's a bank account, but you might actually put cash into the bank account, right? So hopefully that helped explain that. So someone said after I finished the form on the QR code, I got a page that said it was forbidden. Is that okay? No, that's probably not okay. I would say that there might have been some kind of error. Maybe try a different browser if that would do it, but you should get a submitted actual page that flips up, not a forbidden page. So I'm not really sure what happened with that. If for some reason you can't get through into the submitted page, I would recommend that you send an email to the SBDC to let them know that you're trying to register for the SSBCI program and that you keep getting an error of some kind. All right, we are over time, but I've got a few more questions that I'm going to try to get through here. What's your opinion on scanning in or keeping physical receipts? So depending on what system you're using, there are some systems that make the actual act of keeping receipts electronically very, very simple. QuickBooks is one of them. You can use the app. You can just take a picture. You can do the expense right there. Scanning in, I am not a fan of scanning in. If I have to keep a receipt and go back and do some kind of process that requires me to scan it to something and save it somewhere, I will fail. I will be the first one. I am literally that person that puts the receipt in my car, throws it away, months later and never even put it in the system whatsoever. So an app like with QuickBooks is super helpful to someone like me. Otherwise, if you're not scanning them in or you're not taking pictures of them and storing them in something like QuickBooks, then absolutely keep the physical receipts in a shoebox or a folder or whatever it may be. Because if you do ever get audited, then you have to have that information. So whatever works for you. I'm probably going to be the worst person if I ever got audited because I'll be like, well, I probably threw that away. um, let's. Oh, looks like Joy said it's a change because you were doing projects as an independent contractor. Oh, if you're doing projects as an independent contractor, and I mean, your
Bien, mija.
business is being an independent contractor, then most of what I said still applies, right? Because we're looking at it from the business aspect. And if you're paying yourself, you know, you
Bien.
are
Ay, me vine a dormir y me desperté hasta las 8 bien tarde.
let's see. I'm not sure who's off mute. So hopefully, Joy, that answered that question. And I think I'm through everybody now. So if anybody has any other questions that you want to ask, you can go ahead and drop them in there. Otherwise, we are done. And I appreciate you all for joining us today and taking the time to learn more about financial basics. I know it was more information than you probably have received in your life in 1 hour, but there you go. So feel free to sign up for the program, as I mentioned before, or grab one of the upcoming workshops. They're going to be on credit, or they're legal, or they're financial. They'll fall in one of those, and we do often rotate them. So you'll probably see the same topic come up again. But learn as much as you can. And I wish you the best with all of your businesses. And I hope to hear from you guys in the future. So thank you for joining. Bye-bye.